Hello everybody, welcome back to my channel where we talk all things finance and investing. Today's video, I'm going to talk about the S&P 500 ETFs equal weight versus the market weight. Given all the concentration at the top end of the S&P 500, a lot of people are really starting to wonder whether they should shift money away from the market weight ETF that's so popular nowadays and into something a bit more equal weighted. If you're not sure what all of that means, no problem. Stick around. I'm going to give you a good explanation of all of this and help you decide what you should do, equal weight or market weight S&P 500. Okay, so what does it mean, S&P 500 equal weight versus market weight? Well, the most common ETFs, exchange traded funds that are traded on the S&P 500 are all market weighted based on the index. And what does that mean? So what that means is the size of each company. Remember, there's 500 companies that are part of the S&P 500, but all of those 500 companies are different sizes or different values, for example. And the S&P 500 is a market weighted index. So what that means is the companies that are the larger size, just think of Apple, Microsoft, and Nvidia, for example. Well, they're so much bigger than the companies that are number 493, 494, 495. They're just much bigger enterprises. So therefore, they should have a greater weight in terms of the movement of the index. In fact, those companies I mentioned are in and around 6 or 7% of the total value of the S&P 500, the larger companies that is. Whereas the smaller companies are a lot less than that, even less than 1% of the total. So a simple example, if you took $100, let's say, and you invested into a market weight S&P 500, then $6 or $7 would go into Apple and Microsoft, Nvidia. And as the market weights come down, less of your money would go into that, of course. So in some companies, you might only invest 50 cents, for example, of it. So therefore, your returns or the returns of the market weight S&P 500 are going to be more influenced by the bigger companies. Now, the thing about that is, at the moment, those larger companies have done so phenomenally well over the last 20, 25 years that they've got a real high concentration. So the top 10 companies are got a huge weighting on the S&P 500. So the mega cap techs, as they're known, are the ones that will really move the index a lot. Whereas all the smaller companies that make up the S&P 500 have much less of an impact on the day-to-day moves. So your investment money in the S&P 500 market cap, therefore, is more concentrated at the top, and you have less money invested in the smaller companies and the companies that are, say, outside of technology. An equal weight ETF for the S&P 500. How does that work? Well, basically what that does, if you take $100 and you invest into an equal weight, it doesn't invest it based on the weight of each individual company within that. It weights them all equally. So the same number of money goes into each one of those components of the S&P 500. So, simple example, if you invested $500 into an equal weight S&P 500 ETF, then $1 would go into each company. So therefore, you'll have more invested in the companies at the top than the companies down below. And the idea with that is, or the advantage to that is, you don't have this concentration risk that you do with the market weight ETF for the S&P 500. So you would actually get more exposure outside of those top 10 companies. So therefore, you could have more money invested in things like banks or, maybe industrial companies, commodity miners, things like that. So that is appealing to a lot of people who have the opinion that companies outside of tech, outside of the mega cap companies, are likely to have a better performance over the next 5 or 10 years, depending on their investment horizon. So that's why the equal weight version has gotten popular lately. So what are some of the pros of the market cap weighted? Well, if you go into an ETF that's market cap weighted, they tend to be a bit lower in fees. Depending on where you're located in which country, you can get it for 3, 4, 5 basis points, which is 0.03, 0.045, or 6 or 7%. So they tend to be pretty cost effective, where the equal weights tend to be a little bit more expensive, 0.1, 0.15%. So there's a bit of a cost savings with the market weight because they're more standard. Also advantage with the market weight, it will follow the actual S&P 500 index. Follows it exactly. Another advantage, one of the reasons why I prefer the market weight over the equal weight, is you have more invested in the better performing companies. These companies are more highly weighted in the index because they've done so phenomenally well. Their businesses have grown so much and they generate so much cash and so much profits. So from my perspective, I'd rather have more money invested in the more profitable companies, even though there is a concentration risk there. So overall, if you just want to track the S&P 500 normal index at a lower cost and have minimal hassles, for example, and not worry about having less of your money invested in the top performers, then the market weight is the one to go for. There's a lot more options to do that as well. There's just more ETFs available. What are some of the pros of the equal weight? Well, of course, the main pro is that you get the same amount invested into each company. So therefore, you don't have as much concentration risk at the top of the larger companies of the S&P 500. Another advantage is when the smaller companies perform better, then that should outperform versus the market weight, because the smaller companies, the companies say number 300, 400, up to 500 will outperform the larger ones. And that's an advantage in the equal weight. So the equal weight could be better when there's a broad market rally and not just a rally in, say, the mega cap techs like we've seen. But of course, you're going to pay for this. You're going to pay a little bit more in the ETF itself, so just bear that in mind. Ultimately, an equal weight ETF is better for someone who's really concerned about having the concentration risk for the larger mega cap companies at the top. So what about the performance of each one? Well, I ran the numbers, and to be fair, there's not much of a difference at all. Going back over the last 20 years, the compound annual growth rate for each one has only got a slight difference of it. So if you were to look at SPY, for example, SPY, one of the largest S&P 500 market-weighted ETFs going that trades in the US, it's returned around 10.25% each year on average for the last 20 years. But if you compare it to an equal weight ETF that trades in the US as well, ticker RSP, that's had a compound annual growth rate of around 9.65%. So as you can see, the difference between the two for performance is really negligible. If you are interested in a UK listed ETF that's equal weighted, there is one for you as well. Invesco has one, ticker SPXE. And of course, this is not an investment recommendation. Go have a look, read all the documents. Always remember your capital is at risk when you're investing as well. So that's my video on market weighted S&P 500 versus equal weighted S&P 500 exchange traded funds. ETFs are so popular, and the S&P 500 is probably the most popular one still. I myself prefer market weighted. I'm not too concerned about the concentration risk. Perhaps I should be, but I'm not, in all honesty. And I also sleep better at night knowing that my money's got a slightly more invested into the most profitable companies that make up the S&P 500. But what do you think? Let me know in the comments. If you like the video, please click on the like button. Subscribe to my channel if you haven't done so before. And if you want to get an idea what's in my one fund portfolio, the ETF that I use, which is none of the ones I've mentioned on this video, then I'll put a link up here. This is my video on my one fund portfolio. Just click on that. I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.